So good afternoon, everybody. First of all, thank you once again for the invitation to speak about such an important thing, important issue that is how we manage the risk when we are doing digital lending. So today we are speaking about a specific product that is buy now, pay later. Probably it is the most controversial product when we are speaking about digital lending, and I will try to show you all the characteristics and how the risk is being managed by us with our solution in ITSCREDIT. So I'll start to just give you some brief notions about what is the buy now, pay later. Then we will see some numbers regarding how this product has been increasing in terms of popularity and also how it compares with different traditional products like the credit cards that is the main competitor to this product. On the third topic, I will speak a little bit about the trends. As you probably have heard, there have been huge losses in part of these buy now, pay later providers, but also about the challenges that they will have in the future, not only from a short-term perspective, but also from a long-term and a market perspective. And at last, I will speak a little bit about ITSCREDIT, so what we do and how we have been helping our clients in managing their risks during the entire credit life cycle process, not only traditional banks, but also buy now, pay later providers. So, just starting with some very summarized notions about buy now, pay later. So, buy now, pay later is a short-term lending that is provided to customers when they are purchasing some goods in a point of sale or online. So, this gives them the ability to purchase a good or to acquire a good and break its payments in different installments through a short-term period. Usually it will depend on the buy now, pay later provider, but usually it takes like 6 months to pay back the entire value of that good. Usually these kinds of products are interest rate free, so no interest rates are charged to the client, at least if they perform all the payments on time as agreed on the schedule of the product. So here in this example, you have a client that is acquiring a product for example, $80, and then he chooses to pay this product based on a buy now, pay later method. So what you will break the payment in 4 parts, and usually the first payment should be done upfront. So the client, in order to buy the product, needs to do a payment upfront regarding that product. In the behind the scenes, how this works between the buy now, pay later provider and the shop. So this is like, and for the banking, for people that have a banking background, it is like a accounts receivable product. So the buy now, pay later providers buys these accounts receivables to the shop and pays for that the value of the amount less a factor fee that is charged to the retailer. So just some highlights on this product. So usually they are interest rate free, and the way the buy now, pay later provider makes its money is based on this factor fee that is charged to the merchant. Usually it will depend from geography to geography, but usually these kinds of ranges are between 2% and 8%. So for example, comparing with credit cards, the fee is much higher than usually the retailers pay to the incumbents of the credit cards. Regarding the late fees, so if for example a client starts to fail their payments, they incur in late fees, and these late fees also vary too much according to the geography, and it can be like a percentage of the value that is being acquired or a fixed value. There have been also additional ways to charge those fees, that is depending on the number of the late payments that were not performed, or in case of the term of the loan. And I think this is probably in the most recent years, as the buy now, pay later providers start appearing, some players are mimicking some kinds of fees that the credit card incumbents also had. So we are speaking about account keeping fees, about establishment fees, and also processing fees. So there is no longer a free fee product like we saw in the beginning of this period. So some example of buy now pay later providers. So the United States, the main ones are PayPal, Klarna, Affirm are the main players. In Europe, Klarna, I think it still has like a 60% market share in terms of buy now pay later providers. And in Australia, the two biggest ones are Afterpay and Zip. Afterpay, I think it has like 40% of the share of the market. In Africa, we have Motitu, Credpal, that is from Nigeria, but is planning to advance to other countries. And we also have, for example, here in South Africa, Payflex, that was acquired by I think it was in September, it was acquired by an Australian company called Zip, that is one of the major players in Australia. And you also have, for example, in Kenya, Lipa Later and Safaricom. So the telecom company is offering these kinds of products for their clients, but there is a different twist because from what I understood, and I don't know if it's yet like that, but I think so, Safaricom, they provide this product, but they didn't require the upfront payment that the other players were requiring. So it's interesting to see if there will be some problems regarding that process to go forward. So the buy now pay later concept is not new. The designation, it has like 10 years, but it started in the United States and Australia with other designations. It was a way for the customers to buy some goods that they didn't have the funds to buy it upfront. So in the beginning in the early years of this product, they didn't successfully pitch the market, and because of many reasons, but I would think that the two main reasons were because the clients didn't ask for it because they didn't know they existed, and from the retailer's perspective, there were two big factors. So the first one, it was the higher costs when compared with credit cards. So the cost that they have to pay to these companies were much higher, and it still is. And also in terms of all the investment that they have to do in terms of integration to their platforms and providing their solutions. Nevertheless, with the pandemic, people start to spend more time in home and start to go to more online solutions, and the retailers have to adapt their business models to more e-commerce oriented solutions. It was also, I don't think that it was in the pandemic, but some years before, these buy now pay later providers start also investing in two different directions. So the first one is to provide much more visibility about their products to the customers, and also to pitch and sell their advantage to the retailers. So their pitch was like, okay, you are paying more fees for us when you compare it with credit cards, but we will be able to provide you much more sales, much more conversion rates, etc. So it was that, and at last, this product was very popular in the younger generations, mostly because of three reasons. So the customer experience was much better than with credit cards. It was convenient because it was everything online and did with the phone app, and also because in the beginning this product didn't have credit checks to assess the credit worthiness of those clients. So they could buy a product without being asked any type of information to be risk assessed, which was a big problem, and I'll talk a little bit in detail afterwards. So just to summarize, from the merchant's perspective, there were higher average sale size. So as you could imagine, if you break a product, its payment in 4 or 5 installments, you can continue to be adding products to your online cart. And this, of course, increased the average sale size of each purchase. It also increased the conversion rate. And from a retail's perspective, they could penetrate different parts of the population that before, just with credit cards, they didn't have. And also in terms of increased sales volume. So for the customers, we already spoke a little bit about some of them, but I'll take significant importance to the convenience, the credit checks, and also regarding the simplicity of the product. So it is much more easier for a young person to understand that if they buy, for example, a shoes, they can break that installment in equal values during 6 weeks, and that compared with a credit card that you have to manage your balances, you have to take a little bit caution about the fees. It is very different, so they pitch the market very successfully. And also the customer digital experience. But there is a downside on this. So of course, and as you can see, without credit checks, without credit assessment, we will have huge problems in terms of the risks, both for the merchants and for the customers. So what we did start to see, we start to see problems of high levels of debt from some customers. There was a credit score drop that put those customers unavailable to ask different kinds of traditional lending, and also overcommitment, because if they start to add products, they will have a false perception of their buying power, and this creates problems for them. From the buy now pay later providers, it was a problem in terms of image, in terms of reputation, because as you start to register credit losses, the people start to see this product as bad debt and with a bad name. And also, which is usually misunderstood, the fraud that was starting to appear in these products were very huge when compared with different alternative methods like the credit cards, because there were people that were hacking accounts, there were people that were exploring the refund that they usually have on this kinds of buy now pay later providers, and also a significant other behaviors that we saw. So just very interesting numbers about the buy now pay later. So I will not get through all, but I think it's important to say this was a survey that was conducted in the United States during 2 years, okay? And what we see is that the people that was surveyed, half already have been using buy now pay later methods, and from the ones that were not still using, they are expecting to use it in the next months. It was like 40% of that population. I will go to this, yeah. Regarding what type of goods are the clients buying with this payment method and why they are using it when compared with alternative credit lending solutions. So, as you can see, 47% use it to buy electronics, also very high percentage in terms of clothing, furniture, personal care items, and what is very odd, people are still using this to buy some more essential goods like grocery supplies, household essentials, which leaves the question that how much sustainable will be this type of credit if you start to lend money for people to just break their grocery shop into different installments for the future. So this is becoming a huge problem. And also regarding the reasons, so most of the clients said they use it because they didn't have the funds to buy the product up front, but also in order to avoid the credit checks that were requested in different types of lending, and also because part of this population didn't have approved credit cards or other types of credit lending. So they should not be able to access those kinds of funds if they didn't have the buy now pay later provider. So the consequence is very clear, as we see in the right side. So 33% of the clients that were surveyed already had a late payment or failed a payment, and from the ones that were expecting to use it in the future, almost half were expecting to get into a late payment in the next year. So this is huge numbers with big problems, and this will lead to a significant trend that I will explain in detail. There is a good side from this is that when you compare it between the 2020 and 2022, there has been an increase of understanding from the clients regarding the terms and conditions of this product. So at least there is an advantage here, and I think that if you manage the risk of this kind of product and you start to do some credit checks and assess the risks, it could be also a very inclusive product if it is taken properly in terms of lending. So I will not get in all of this detail, just an example in the image on the right. So you are buying a product online and you are putting in front of you available different options to pay it. So you have the usual credit and debit card, and then you have different companies and buy now pay later providers that show you how you can break the payment in different installments, okay? So getting to the comparison with the more traditional ways of lending, the credit cards in this case. So as you can see, the interest rate is a product that is interest rate free. And usually you don't have fees if you pay everything on time. From the credit card's perspective, you also have interest rate free if you don't carry a balance to the additional month, but you have a variety of fees. Also, regarding the credit checks, as I already told you, there are no credit checks, and please take this carefully because there are some players that are already doing some credit checks, that are already requiring information on their clients to do this assessment. This is a broader view of the buy now pay later market. So they didn't ask for credit checks, they didn't ask for good information about those clients, while in the credit cards everything is checked as it makes sense. It is an unregulated product still, although the UK has started to perform increase some regulations on that part. It is still currently a very unregulated product and should be regulated in the upcoming months, at least in the United States, Europe, Australia, and UK, okay? And from a client score perspective, it is very different from the credit cards because, for example, if you have a credit card and you do your payments on time, you probably will see your credit score improve because not only the late payments are reported, but also the on-time payments are reported. But in the case of buy now pay later providers, it's different. So the buy now pay later providers only reported to the credit bureau the late payment. So that is a big difference. And also, for example, the payment frequency, usually this is bi-weekly basis, where the credit card is monthly. And if the client starts to have some problems, usually the buy now pay later providers provide a longer repayment period when compared with credit cards. So, trends and challenges. So, as I told you before, there was a significant increase in the popularity of these products. As you can see on the left side, I have in the first graph, it is the Australian market between 2012 and 2020. And as you can see, there is almost a complete replacement between the revenue that the buy now pay later providers have and the ones that the people from the credit card industry are losing. So there is almost a perfect replacement. And also during the year of 2020, that was when these buy now pay later providers start to have a significant increase on their revenue and their profitability with the pandemic. You can see here a comparison of the stock market capitalization of MasterCard price of MasterCard and Afterpay, that is one of the biggest players in Australia. Nevertheless, as occurs every time, if you start to increase your popularity, if you start to grow immensely, this comes with a cost of credit losses. So in this last year, we start to see huge credit losses reported by those big players on the market. I have here just some news. So Klarna quadrupled their costs. Affirm have a hit of 93% of their share market prices down, and also plans that were starting to shed workers, etc. And as you can see, this is the year of 2020. The value of these companies have dropped significantly in the last months, and this was due to all the costs that they were piling up because of their existence of credit checks. So, regarding the challenge of this payment method, so there will be, of course, a significant increase of the regulation of these products. you'll probably start to see significant costs and requirements to these firms as they cannot continue to provide credit without any kinds of credit checks or assessments of the risk of the clients. You also start to see one important thing that most of the people misunderstood in the beginning, because these players have a big disadvantage when compared with banks, because banks have a reliable deposit structure, have access to international funding conditions that are much better than compared with buy now, pay later providers. So as the cost of living start to increase and the interest rates start to increase, those guys start to have huge funding costs that created problems also in their business model. From a cost of living perspective, and as you see from the survey that I showed you before, probably most of the part of the population that start to use this were the ones that were more subprime or with less creditworthiness in terms of ability to pay their payments. But as the cost of living increases, it will impact significantly much higher those types of clients. So you'll probably start to see some shifts in terms of the type of goods that they are pursuing and acquiring with this payment method. And also, in my opinion, the major issue it was credit losses. And the credit losses should always be seen in two different perspectives. So what will be the probability of my clients start to fail? And if they start to fail, how much can I recover from those losses? So, of course, these buy now, pay later providers have to start doing some risk assessment analysis of those clients, start to improve their collections process, because if they don't do it, they will disappear, because there is no more time to continue to grow without any cost in terms of the credit losses. And from a more market perspective on this industry, I would probably highlight two major issues. So you start to see big players entering this market. So you have Apple, you have other big e-commerce companies, and also you have JP Morgan that has something that is called My Chase Plan, where they are providing buy now, pay later providers, so buy now, pay later services. So as you can see, even a bank can provide it, but it can be done only based on a strong and comprehensive risk assessment framework. And also, as you saw in the Adidas figure that I showed you before, the customer starts to see different options when they are buying a good. So they will have to somehow create loyalty programs for their clients in order to assure that when the client is buying something, it will use you, the buy now, pay later provider A, and or the X, the Y, that are being shown when you are doing your purchase. And also, from a consolidation perspective, I would say that as these funding costs increases, the credit losses increases, and all the problems that most of these companies start to have, you will see consolidation processes around the globe, and you already see it in many geographies, like I showed you before. So to end our presentation and to speak a little bit more about the ITSCREDIT. So ITSCREDIT delivers a platform that provides full control to their clients. It can be banks, it can be buy now, pay later providers, it can be fintechs that are doing some business in the lending world. They provide full control of the entire credit life cycle of the product. So you do the onboarding of the client, you collect the information, the documents, you manage all the credit workflow, you assess the risk of the client, you calculate its credit score, you return it to your provider, and also you get sure that all the approval steps that are needed are pursued and are complied within this solution. We have also, and that was the reason why I started partnering with ITSCREDIT in the beginning of this year, we start highly investing in the risk part of this solution. So we developed a set of statistical tests that were developed to ensure that when you are using a scoring model, you can assess it on a comprehensive way. You can see if you have to provide some different approaches or not. And as you see, we are present mostly in Europe, Africa, and also in the North America with Canada. Here in Africa, we have clients in Kenya, Mozambique, Nigeria, and Angola. So my last slide is about those features. So as you understand, managing credit risk on lending is very difficult. But if you put on top of that digital lending, it will become much more difficult. And especially because most of these firms do not have historical data. They can partner, they can buy some historical information and credit behavior of their clients, but usually they don't have historical data. So it's important to provide them the features that allows them, as they start their journey, they have a very quick and flexible response and answer to adapt their scoring models in order to change it and to adapt them to the new conditions. So the first, there are other features, but I'll talk a little bit in detail on 6 features. So the first one is model configuration. So imagine a client that has different models for different parts of the population. So it will be able to configure all the rules, all the variables, all the assessments that must be done, and they can change it based on a data model structure. It's also important to provide information that with ITSCREDIT, you can calculate automatically the credit score of the client based on information, and then verify all the credit decision rules and the limits in terms of credit. Because it's important to note an important thing is that what is the biggest advantage of the credit buy now pay later providers compared with banks is the customer experience. So if you somehow start to create problems in terms of the customer digital experience due to the excessive information that is being required to do the risk analysis, it will be very difficult. So there is a trade-off between both of them that in order to pursue and continue to deliver that solution to the clients. We also have created a toolkit of statistical tests to be performed over the scoring model to provide insightful information to the risk officer. So, for example, at any time, the risk officer can access our solution and start to see what are the results regarding their scoring model in terms of quality. So, is this model discriminating goodly between the good clients and the bad clients? Is this model stable? There are problems with some variables. There are some variables that should be changed. There are some variables that are reducing the capacity of the model to correctly identify the client. So we have developed a set of statistical tests that I also developed in my past background on Deloitte and also as an independent advisor to the European Central Bank. Afterwards, we also start to investing on machine learning because it is true that you have to, I think the key word is monitor, validate your model, but it is important also to capture different kinds of information, behavioral information, and start to challenge your own models. And usually with artificial intelligence, you can track some patterns that usually the other kinds of models, more traditional ones, are not able to capture. So it is important not only to test your model, but to continue to challenge it as new information is being arrived, not only from a client perspective, but also about their default payment behavior. And the 2 last features are marketing leads. So as you understand, if you start this process and you don't have sufficient historical data, you have to start with a judgmental model. And to do that, you have to start slowly. You have to see that probably you'll not be able to capture significant parts of the population, at least in the beginning. So you have to pre-score entire parts of your population to see what will be the best clients to start. And you have to start with those clients because one thing is for sure, the first people that will be asking for this product are the ones that are going to default later very quickly. So it's very important in terms of this part. And also the impact simulation. So we are speaking about customer digital experience. We are speaking about quick responses, automatic calculations. So you have to have the ability that if, for example, you find that your model is no longer good, your scoring model is no longer good, and you have to change this variable and the other variable, etc., you have to pre-assess how this will be impacting your business model, your scoring distribution from your entire population, and before you do those changes, you have to pre-screen and assess all the changes that will lead in terms of your portfolio, in terms of risk. And I think it's all. So thank you very much. So any questions?
Thank you. I think a lot of the examples were given in markets that have either good credit bureaus, good credit card systems, probably single switch and stuff like that. How can we apply that to purchases that are not e-commerce, much more like the traditional Brazilian way of paying, buy now, pay later that they've used all their lives in Brazil. Well, in that case it was checks, but we want to kill checks too, not only cash. How can we make it work in these jurisdictions where the credit card usage is much less pronounced and the e-commerce is less used? So can we apply that to physical stores, and how can that model help there?
Thank you very much. It's a very important question. Yes, you can apply it not only buy now, pay later services, but also more traditional ways of lending. Of course, there are significant differences and challenges that you must consider when you are using information from the credit bureau or not, or you are using information on consumer behavior, etc. But the solution that we have, it's flexible at the point that you can use it for all types of credit lending. Of course, there will be some challenges, and probably if you start having lots of information on the credit bureau or other kinds of informations, you have to perform some data quality assessments before, because this is very important. And we have also a feature there in the model validation, because if you don't use the data, because there is a misunderstanding sometimes that if you have the data, you will have the best scoring model in the world, you know, and that is not true, because usually if you have garbage in, you will have garbage out, and you have to do all the data quality and data cleansing processes in terms to fetch the data, have good data, and then provide the best scoring solution. But I think from my perspective, you can use it in different ways, and it's flexible enough to use it in different geographies, namely in the case of Brazil, that you have a very strong competitors in terms of credit cards or something like that. So thank you once again.